The International Monetary Fund, or the IMF, is revising its global growth forecast slightly upwards. And this upward revision is attributed to strong consumption and investment in the United States and many emerging economies. However, the IMF warns that this positive trend could be short-lived. They caution that high debt levels in most countries and the ongoing battle against inflation pose significant risks. If these challenges are not addressed, the global economy could face a tepid 20s characterized by sluggish and disappointing growth throughout the decade. The IMF chief, Kristalina Georgieva, highlights the delicate balancing act central banks face now.
On this final stretch, it is doubly important that central banks uphold their independence. As we know, policy credibility is vital in the fight to restore price stability. Where necessary, policymakers must resist calls for premature interest rate cuts, because premature easing can see new inflation surprises that may even necessitate a further bout of monetary tightening. And we have to recognize, on the other side, delaying too long could pour cold water on economic activity.
The IMF also warns of a growing economic divergence within and across countries. The US economy is experiencing a strong rebound, while Europe faces a more gradual recovery. In China, Georgieva backed reforms to turn around a struggling economy.
Look, I mean, if China does the reforms that we recommend, they can get massive benefits. They can lift almost 20% their output over the next years. On the question of overcapacity, as we recognize, there have been sectors in the Chinese economy over the years where overcapacity has existed. It is critical to develop domestic demand and then shift more of the economy towards services, so this doesn't persist as a problem for China.
The European Central Bank has kept its interest rates at record highs, but the central bank also sent a clear signal that it may be preparing to cut them as inflation continues to fall. The central bank for the 20 countries that share the euro currency kept its deposit rate at 4%, and this rate has remained unchanged since September as part of its effort to control prices. Here's what ECB chief Christine Lagarde told the media after the rate pause.
The Governing Council decided today to keep the three key ECB interest rates unchanged. The incoming information has broadly confirmed our previous assessment of the medium-term inflation outlook. Inflation has continued to fall, led by lower food and goods price inflation. Most measures of underlying inflation are easing.
But things are expected to change soon. Inflation is now close to the ECB's 2% target. Bank lending is at a standstill and the economy is barely growing. The ECB has now dropped fresh hints about a possible cut at its next meeting. ECB policy makers have been supporting a rate cut at their June 6th meeting, but a rate would depend on two factors: key indicators like wage growth and inflation moderating, and the Federal Reserve cutting its rates in June.